Hello, everyone, and welcome to Net Zero Compare. Today, we are joined by Tim Geller, co-founder of Alectro, a company working on solutions related to sustainability and climate change. Tim brings a perspective from building a company in this space, dealing directly with how organizations approach emissions, data, and decision-making in practice. In this conversation, we'll focus on what's actually working, where companies are getting stuck, and how sustainability efforts translate into real operational and financial outcomes. Tim, thank you for joining us today.
Lovely to be here.
To start, can you briefly walk us through your background and what led you to co-found Alectro? I'd like to understand how your previous experience shaped your view on sustainability and where you saw clear gaps in the market.
So I guess as a background, I studied as a chemical and nuclear engineer. In the nuclear engineering world, you do lots of scenario modeling where you look at, I guess, cheapest units of electricity or how the future of electricity really looks in terms of generational mix. That really spurred on my understanding of how, I guess, climate transition models work as well. From a professional perspective, I had a chance to work with a management consultancy that would work with heavy industrial processes like chemical factories to auto manufacturing. The speciality that I was really looking into was how to reduce waste and energy. And again, it was more around figuring out how to give practical advice to end clients rather than just giving top level strategy advice on that perspective. Those two elements, I guess, together formed my interest in terms of sustainability and how to create a software tool. But naturally, I had the pleasure to be working with my co-founder, Bertie, who has the technical expertise from a product development perspective as well. And I guess the two knowledge bases of his ability to create a software tool and my understanding of how to deliver value to the end client really formed Alectro as it is today.
That's very interesting. I'm always curious about what happened and what prompted founders to set up their companies. So thank you for that. And if you could tell us what specific problem is Alectro solving today and for which type of companies does this problem matter most? Because there are many tools and platforms in the space, so it would be helpful to clearly define where Alectro fits and what makes the problem you're addressing worth prioritizing.
Really, yeah, I would say the market's very saturated in terms of a lot of different tools that all do different things. The way that we designed Alectro was really looking at a specific market, and that was looking at businesses that are sub 2,000 employees. What our, I guess, real bread and butter is that it's organizations that have between 100 to 250 employees, but no one is independently wearing the sustainability hat. So you would have someone who's just more of an eco warrior who put their hand up and is wearing the helmet of saying, oh, I'm going to do something good for sustainability. And as a result, the way that we designed the product is to make it as easy as possible for any organization to start with the measurement process, but moving away from the spend-based approach that a lot of other tools are used at the moment that are out there on the market. This basically allows any business within, I would say, 2 to 3 hours to upload data. The system does its fancy categorizations and then to give advice that is actually usable and trackable from the end client. And as a result, that's the main niche that we're really working with at the moment. I would say that there's more advanced tools out there as well that really allow people to spend all day on a carbon accounting platform. But I would say that's more for companies that have a whole sustainability team where someone is updating every line item one by one to make sure the right conversion factor or emission factor is in there and in place. So our tool still allows people to go down to that level. I think the main USP is definitely the fact that any person that doesn't have any sustainability background can log in, get started, and deliver a compliance-ready report to their board within a couple of weeks.
So, if I understand correctly, your tool is also a perfect fit for small and medium-sized companies, right? Without having large teams, as you mentioned, of sustainability and research analysts.
Correct. Yeah, exactly.
Okay, that's perfect. And from what you're seeing today, how are companies currently handling emissions tracking and sustainability reporting in practice?
I would say it's Wild West. I think a lot of people do certain things very independently, just on Excel spreadsheets. Whilst I would say that is on the one side of the spectrum where someone has been doing it for a very long time, but the systems are very clunky, meaning that if something changes or if they want to go backwards for a mission year, it could break very easily. To the other side of the spectrum as well, where people are very much limiting in terms of what they are publicly reporting as well. So they are very much being opaque in terms of what they want to actually report. And I think it causes some discrepancies when certain organizations want to see how they compare in the market. And as a result, I think the most important part for any organization is to make sure that if they're doing emission tracking or starting their emission journey, is to put in place the right boundary of what you want to measure, and then to settle on one type of methodology to continue tracking that across multiple years. Because I think there's lots of times where people are being very narrow in terms of what they want to measure, or they just pick and choose year after year what emission factors or what methodology or what protocol they should be following to make sure that it aligns with what they want to see rather than what reality is. And I think the world as it is today is that there isn't especially for SMEs, there isn't a carbon police out there going around trying to penalize people if they have too much carbon. So I think from that perspective, being most transparent is actually the best thing to do rather than trying to, I guess, trick the calculation process itself.
That's a funny fact because most of companies that we talk to also always mention Excel spreadsheets. So probably they are still in place and used by many.
Yeah, agreed.
And there's often a gap between what's expected on paper and what's actually happening internally within the company structure. And in your view, at what point do companies typically struggle the most when trying to manage or reduce emissions? Whether it's data collection, internal alignment, or implementation, I think it would be great if you could pinpoint where things tend to fall apart.
It depends on what year the organization is in terms of the reporting journey. I think if it's your very first baseline year, naturally the places where you are facing most obstacles is getting people on board with the project, because you have to go to procurement loops or legal hoops. Getting people to agree to start measuring is always a very difficult thing because people don't know what to expect. And there is a fear of unknown in everyone. You don't know, if you don't know what's going to happen, you probably say no, but let's not start. After that, I think if you get agreement to start, making sure that the data does flow in, or you do have the right data, is always a problem. I would say initially as well, until you've done it once and you realize it's probably quite easy to find the data. And adjoined or adjacent to that, I would say, how good is the data that you're providing? Sometimes there's reiterations after the first year to provide more granularity, which is also quite good because I think that reveals quite a lot of return of investment to certain things. If you can recategorize a lot of financial data, it will reveal actually places where you could save some money, which is some good return in terms of doing a sustainability project. Whereas I guess if you're moving on to the second, third, or nth year of assessment, I think people start more debating which areas have the best return of investment if you were going to put some money into place to reduce your carbon footprint. And I think more organizations should list the actions that they can take forward, and then also list the costs they believe an action would take, because then it will give you an insight of saying which one is the action that has the lowest cost per reduction of carbon. Naturally, there probably will be ones that will be more difficult to implement or not, but I think it's a good debate. A lot of ESG teams, or the people that, or green teams, depending on who's driving this forward, should have internally to make sure that they know what they're doing year after year to reach their science-based targets or just their net zero targets in the near term as well, by making sure that they're aligned with the actions that they do want to take forward. Again, lots of tools out there to suggest or what actions to take forward. But again, it's just making sure that the environmental management systems that people have in place allow for this accountability and repeatability of viewing your emissions, reviewing your actions, and then either pivoting to making sure that you actually meet your target or not.
Got it. And now I'd like to talk about scope 3 because this one is pretty confusing for most of our organizations at the moment. So, scope 3 emissions are often described as the most difficult part. From your perspective, what makes them so challenging to deal with?
I would say initially it's definitely drawing the boundary, because if you imagine your scope 3 emissions, they could be endless. In terms of if you're putting money anywhere, it will have a domino effect that will keep going on and on and on and on. So for you to decide where does the service stop that you're offering, or where does your product stop? If you imagine the life cycle of a computer, for example, even once it's retired and the parts have been taken apart, it could be reused somewhere and the recycling process begins again. But if you are the original equipment manufacturer of the laptop, when do you say that stops? When is your responsibility finished? So as a result, from a scope 3 perspective, it's making sure that when you do start doing the assessment, is to draw the boundary in a way that you think, or you know that you have the direct control of the outcome at the very end. Because as soon as you can't control what's going to happen, how can you keep control of your emissions as well? Secondly, I guess the greenhouse gas protocol is quite versatile or malleable. I think that creates certain elements of not knowing where to put certain emissions. And again, there is no right or wrong answer here, but again, it comes back to being transparent and sticking with one method of going forward rather than choosing and picking. Again, if you're using a carbon accounting tool, it will decide on your behalf, or you may have the choice whilst doing it. A good example is if you're leasing a building, should you pay, or should you include some of the heating in the building into your scope 3 emissions because you're leasing the building, or can you put it into scope 1 emissions? And it's a debate a lot of people have because they say they can't really control in their lease buildings, or they actually can if they really wanted to. But maybe that's a good thing about the greenhouse gas protocol, that it is a little bit more flexible rather than giving a rigid structure to everyone. So from that perspective, making sure the individuals who are doing the assessment have drawn the right boundary and have stuck to the methodology is probably the most critical. And then thirdly, I guess what everyone always goes on and on and on about is finding the right activity data for your scope 3 data is very, very difficult. But it is a iterative process, meaning you're not going to fix it overnight and you're not going to fix it in one reporting year. You need to start engaging with your suppliers upstream and downstream to collect activity data. And the only way you can do that is to make sure that you have the right supplier engagement tools in place to collect that information. Otherwise, sticking to solely a spend-based methodology will just make your emissions explode year after year if you're going to spend more money.
Thank you very much for giving those examples, because I think that they will clear off many doubts and they give a clear picture of the things that you've just mentioned. Now I'd like to talk about data quality versus decision making. So if you could tell us, how should companies think about trade-offs between perfect data and taking action? Because there's often a tendency to deal decision while waiting for better data. So I think it will be also useful to understand where good enough is actually enough.
Completely. I think this is a very simple example that I often give to people when they first start their assessment, because I would say most people, they don't understand what is a ton of carbon. What does a ton of carbon actually mean to someone? Because they haven't really, you can't see it. It's intangible in that sense. So even if you gave a score to someone out of 100, and then next year they need to get to a 90, people can understand that very quickly because they say they've improved by 10%. So as a result, I think this argument about poor data quality shouldn't really exist if you're capable of identifying where your emission hotspots are. Because whilst I would say it's great to be an accountant to go to 7 decimal points and figure out what your emissions really look like, I think at the end of the day, the process that you're doing, why you're doing this, isn't just because you want to be a pencil pusher and figure out what emissions really look like. You're doing it because you want to reduce your emissions. And as a result, I think if you're capable of being transparent and drawing that organizational boundary of knowing that you're measuring everything, for you to then identify these emission hotspots. And again, lots of tools will allow you to do that, to figure out where are most of your emissions that you can actually figure or basically impact before diving deeper. And I think what I've seen loads of companies do is say, we're not going to measure this because we don't have the right data. There will always be benchmark or I would say like gap analysis tools that you can use to fill in that emission area with secondary or tertiary data to find out what the impact of that area is. And only once you've been able to basically measure your full impact in your baseline period, you should start focusing and drilling down and getting more activity-based data on that specific category to actually improve it. And I think a lot of people are just numbers obsessed and they want to keep going and they want to get the exact impact at the very end, but you should really focus and drill down all your energy on those emission areas that you can actually have the biggest impact on your emission portfolio. And I think also from a measurement perspective, if you're implementing actions, you really want to see that improvement as well. So I think making sure that you're tracking maybe not carbon, but the activity metric that dictates that emission hotspot is as critical as actually finding out exactly what the functional unit for that area is as well.
Got it. You've already mentioned the importance of taking into account the return on investment. So how do you typically frame the business case for sustainability initiatives when speaking with companies? Let's say, especially in terms of cost savings, risk management, or operational efficiency, rather than just compliance.
Really. And I think it's always the easiest way to sell anything if you can tell the person that if you spend $1, you get $3 back. I don't think there's anyone out there that will not say yes to you. I think the easiest sell is, of course, if you have a bid on the table with a big business. Let's say you're working with a big bank and you see the due diligence matrix and you can see that they have points allocations towards ESG, meaning that you're more likely to win a project. And as a result, you get direct financial benefit, meaning that you basically outperform your competitors. If you have a case like that with any of your clients, it makes the selling point very easy because they're more than willing to invest some money, with the likelihood being much higher to win a project that will return some, I guess, value to them that is magnitude or 2 magnitudes larger than the investment in the sustainability bucket. I would say that's the best selling point. The second one is if organizations have been measuring their footprint year after year already, it's a quite easy calculation to pitch to someone to say, how much does this person cost on an hourly basis? How much does he cost on a monthly basis? Because if you're able to draw a cost benefit in comparison to how much the, I guess, operational efficiency of a tool like this will give to an organization, it will mean that you very much easier to basically explain the cost for a tool. Because if you're making someone save 20 hours, what is that 20 hours really worth to the business? And if you can give a direct example like that, you can sell a software tool quite easily as well. I would say the third one is a more difficult because it's not a direct benefit, but it's often a way that people see the benefit on the second, third, or fourth year. And that is when people are starting to engage with their suppliers around their activity-based impact. So let's say you have an architectural firm that you're working with and you see that they don't report their carbon emissions, and then you send out your supplier due diligence form. And as a result, you get some information back, or they will say they don't give it to you. Next time you're going to engage with that architectural firm, you might go out to the market because you want to get a sustainable architecture firm to work with you. Because you're going to the market, like with anything, asking multiple studios for a proposal will result with a likely cost saving in that particular field. And you only did that because you started engaging with your suppliers around sustainability. So I would say there's some hidden procurement benefits that often people start realizing when they start doing the process properly as well.
Very interesting. Thank you very much for those examples you gave. And now let's move on to regulatory pressure. So nowadays, with regulations like CSRD, which is Corporate Sustainability Reporting Directive, and ESG requirements, broader ESG requirements coming into play, how is this changing the way companies approach sustainability in your view?
I think it is a very good lever, but it's not a good lever for the people selling sustainability products, I would say, because you're in the hands of government parties. And as a result, overnight, things could shift very quickly, meaning that, let's say, I had 20 US clients, and overnight the environmental regulation in the US changes. I could lose all 20 clients really quickly because the incentive isn't there anymore. Similarly, we saw it with the omnibus decision here in Europe, where CSRD basically got limited to a much narrower set of organizations that need to report on. It means that you're basically in the grip of regulatory or compliance drivers. From a company perspective, though, if you are approaching sustainability like that, you're not really approaching sustainability with this more classical triple bottom line approach. You are looking at it completely from a compliance angle, and you're not going to be really focusing on reduction. You're only going to do your bare minimum. And I think there's so many studies, and I think one of the really good ones that was released recently by the Boston Consulting Group is what is the real return on investment to an organization if they are reducing their emission year after year. And it goes through I guess, a plethora of different benefits, from customers to clients to products or even staff happiness. And I think if you're approaching sustainability beyond just that compliance perspective, it will make your business much more profitable or successful in the first place. However, if the government isn't incentivizing organizations to start reporting their emissions, many will not. And as a result, there needs to be an overarching decision from company or from governments to actually implement these regulations. It's one of these things that if a country has the ability to put legislation in place that goes over many terms rather than just a single term of a single party, it will make a huge difference from a, I guess, reporting perspective, but also for organizations to actually reduce year after year without having the, I guess, setbacks if legislation doesn't require you to do anything for 4 years or 6 years, depending on how long typical parties are in power in different countries.
Exactly. And are companies becoming more proactive in your view, or is it still largely a compliance driven exercise?
I would say there is a voluntary reporting driver that is coming in place, and it's getting a lot of organizations to do better. I would say that's more focused on B2C organizations rather than B2B. I think B2B businesses are very much following what the government suggests for them, because ultimately they have single relationships with their largest customers. But from a B2C perspective, if you're working with quite a lot of individuals, standing out is much easier if you're a green organization in comparison to a non-green organization. And the best example I could say to this is if a product had exactly the same price and you went into the supermarket, you would always pick the more sustainable product over the non-sustainable product. And I think that tells you a story straight away. So I think as soon as that market exists, there is a market for sustainable products.
I couldn't agree more. And based on your experience, what are some common mistakes companies make when starting their sustainability or emissions reduction journey? I think this could help listeners avoid wasting time or resources on approaches that don't lead anywhere, in your view.
I think making a decision on the tool that you want to use is a very, very long debate that people start off with. I think if you really wanted to start your assessment and you don't get the buy-in from management for budget, doing a single assessment, even one of the free tools that are out there to do a spend-based assessment to get you a baseline measurement is an excellent way to then go back to your management board and say, look, this is our impact. And the only way that we can improve this is by having better granularity. And as a result, I think if you are the eco warrior or the person that wears that sustainability helmet, you need to have some sort of return of investment when you're pitching it to your budget holders or your stakeholders. And I think often the subgroup of people that are driving this forward, if they don't have management buy-in, struggle to actually force any change in their organization. And I think the same questions that you asked me today, having the ability to show the benefits directly that are relevant to you, or even showing how your competitors or direct peers have benefited from their sustainability journey, makes your selling point much better. And as a result, you can start your journey straight away within your own organization. It doesn't matter if you're 5 people or 2,500 people. I think as soon as you have the ability to show benefits of sustainability that are applicable to yourself, you do very well in the long term as well.
And looking ahead, which types of solutions or approaches do you believe will realistically scale across industry, let's say in the next 5 to 10 years?
Well, this is a very good question. I think ultimately the dream is, I think if there is removal technologies that are affordable for any organization, that would make anyone's carbon reduction journey much easier, because it will allow people to figure out solutions for themselves for these ongoing or unavoidable emissions that a lot of people are struggling with, especially if you're a smaller organization that can't change their full business model and have a lot of scope 3 emissions that are just going to be permanent until their suppliers adjust their methodologies. So as a result, if there's ways for people to reduce their emissions through cost-effective technologies like direct air capture that is affordable to any organization, for example, that would make a massive step in the right direction for any organization to ultimately create net zero goals that are feasible and realistic for them to reach as well.
And is it just in theory for now, or you can already see that from real implementations or customer behavior?
I think if there's customers that have very deep pockets, you can see that they are doing that already. I think for the more layman general customer, I think it's still the dream in the sky, hoping that it will come to them as well. But I think that's why there's leaders in the market. And as a result, when the leaders are investing in these technologies and it's leading down the right way, it will drive costs down. And as a result, other organizations can follow and ultimately benefit from these technologies as well.
Before we wrap up, is there anything we didn't cover that you think is important for companies trying to make practical progress on sustainability, or anything that you think that is overlooked or misunderstood?
I think one of the key benefits as well from sustainability is sharing the results with as many people in an organization itself. So it's more of this handprint rather than footprint, because even though you're not measuring if what will happen to an individual if they go home, but if they have the knowledge in terms of where emissions really come from, they will adapt their own lifestyle as well. So I think having the ability to engage your whole employee force outside of carbon measurement will be a very, very critical thing in the long term as well, to see this handprint really decrease across organizations outside of the classical carbon footprinting exercise as well.
Tim, thank you for sharing your insights. This was a very grounded and practical look at how companies are actually dealing with sustainability today.
Lovely to be on the call today.
And thanks to everyone for listening. As always, the full conversation will be available on Net Zero Compare, along with a written summary and key takeaways. If you're evaluating sustainability solutions or trying to better understand what works in practice, feel free to